Hi investors, welcome to SOIC. तो आज के इस इंटरव्यू के अंदर व्हाट वी विल बी डूइंग इज दैट वी आर होस्टिंग मिस्टर सजल कपूर एंड ही इज नोन टू बी अ फार्मा एक्सपर्ट एंड इसके साथ साथ ही इज ऑल्सो रिसेंटली रिटन अ वेरी इंटरेस्टिंग बुक एंड एक्चुअली में बुक हमें एंटी फ्रेजाइल थिंकिंग के बारे में बताती है कि अपने इन्वेस्टिंग फ्रेमवर्क को एंटी फ्रेजाइल कैसे बना सकते हैं बिकॉज मोस्ट ऑफ द थिंग्स आर फ्रेजाइल इन नेचर। तो आप कैसे किसी चीज़ को रोबस्ट बनाएं एंड उसको इतनी स्टेज पे ले जाए कि दैट थिंग बिकम्स एंटी फ्रेजाइल, माने डिसऑर्डर से जो चीज़ गेन करती है, केओस से गेन करती है। So in this entire video, we'll be basically gaining his insights from the pharma industry and also his investing philosophy that is of anti-fragility and एक retail investor अपनी investing journey में anti-fragile mindset को कैसे लगा सकते हैं। With this, let's start.
Thanks, SOIC and Ishmoit for the Zoom recording and all the logistical support. So here is a important disclaimer, everyone. None of what we would be discussing is an investment advice. It is just an opinion, and I'm not your financial advisor. That said, so education and healthcare are very close to my heart, and I'm sure you guys must be supporting many charities as well. So maybe it's a little nudge that if you can try and do more for your existing charities, you don't have to support this or any other cause, whatever you relate with or resonate with. Feel free to do a bit more. Every little helps, and I really relate and resonate with Anne Frank's quote that no one ever became poor by giving. So let's dive right in. This picture is looking rather uncertain and disorganized, right? It's almost, and it's not symmetrical. It's kind of tilted on one side. It almost feels fragile, right? So it's imperfect and it's incomplete, and that's all this uncertainty is all about. And I like imperfect things. So we probably understand what we mean by lumpiness and randomness, but let's try and see what are the possible antidotes and these sort of firefighters that can help us survive in this uncertain world where it's almost impossible to predict anything. So I would start with bricolage here. I mean, it's a French word. It means make the most of your available resources and capabilities. Um, and then I think it's applicable for investors, it's applicable for decision makers, managements, even scientists, because if you are trying to innovate and invent something new, it's an experiment, and if it's an experiment, you don't know the outcome, so you will have very little data or information to play with. So in that sense, bricolage is an antidote or a tool or a firefighter in that context. Um, then fait sur mesure is a French word and literally means made to measure. So depending upon what sort of resources and capabilities you have in an uncertain world, you can design your strategies both as an investor as well as a CXO who is making some significant decisions that may impact hundreds or thousands of employees and the partners across the supply chain network. Next one I think is so transilience and pivoting. So transilience is a combination of transforming while staying resilient. So if you watch basketball, when a player is passing the ball, they keep one foot planted and they change direction, they pivot, and then they pass the ball. So they are grounded and yet they are transforming. And so that's what transilience is all about. And it helps in an uncertain world because you will have to pivot multiple times and you would have to transform multiple times. And because you don't know what you don't know, the future is uncertain, right? And optionality again is a very fundamental driver. The more uncertain the world is, it's better to have lots and lots of optionality, whether as an investor. So that's the reason we create a portfolio. And as a company management or a CXO, you will have a range of options and projects in the pipeline, because it's impossible to predict which way the world would start swinging. And of course, with optionality, you need margin of safety, 100%, because you cannot just expose yourself at any sort of valuation as an investor. And likewise, for a management, you need to have your margin of safety. You cannot bet the whole business of the company when you're planning to counter, things such as variability, volatility disorder, so on and so forth. And here, when we talk about uncertainty and volatility, disorder, randomness, we are talking about the extreme end of all of that. In any business, uncertainty is a given. But when you are trying to create something new and you're trying to innovate, you are dealing with extreme uncertainty. And extreme uncertainty is non-linear in the sense that the kind of decisions you are making at the other extreme are not sort of linear. So your judgment is important, and following your mistakes and past lessons, almost sort of heuristics, because there are no rules. It's an uncertain world. Rules don't really apply. So you need to almost work with a range of heuristics and decision making. So I'm not sure if you have read that um, successful and famous book from Daniel Kahneman and Amos Tversky, Thinking Fast, Thinking Slow. Um, Most of us have got this tendency of thinking fast, impulsive behavior, whereas we need to slow down, because when you slow down, you make a better decision. So all of that is very relevant for both the investors and the managements, because we are dealing with extreme uncertainty here. And I believe we used to be anti-fragile in the ancient times, and we are moving from an anti-fragile world, starting with the Gurukul culture, to, even if I go back to 80s, I mean, I remember I used to cycle to school one way, 7, 8 kilometers. I'm not sure if anyone is from Lucknow. So I used to be near Charbagh station, and from there I used to cycle all the way to Mahanagar and back. So that was a different world. The pollution was lower. We were more natural. So exercise was kind of natural. We were not going to gym to exercise, right? So we were kind of robust, if not anti-fragile. And now we are moving towards this fragility. We have got sleep and mental disorders, unhealthy eating, pollution, air conditioned offices, homes. So we are kind of getting in this comfort zone. And imagine a scenario, and again, it's a hypothetical scenario, but what if there is a synchronized grid failure? Either could be a terrorism or a ransomware. Right from mobiles to cars, everything is electric. And so we are kind of very fragile. We just need one major event to bring us all down to our knees. So we need to think about that. And again, it's not a black swan event that I'm talking about. It's probably a gray swan, because it's probably will happen at some point, right? So we need to just be aware of that behavior. And just to give you guys a sense of what do I mean by fragile? I mean, fragile is anything which hates volatility, pretty much. And when you've got more downside than upside, from small mistakes. So again, we are talking about small mistakes and errors here. When you've got more downside than upside, you're fragile. Robust is what recovers quickly and stays unchanged. So if there is a COVID kind of a scenario, the hospitals were kind of negatively affected, but when the COVID wave was over, they bounced back. So typically, consumer companies, anything to do with essential consumption will be robust, and that's the least we should try and be. So whenever we face stressors, we would take the hit, but once the stressor is out, assuming it's a short-term stressor and we get time to recover, we should neither be harmed nor gain from that volatility or disorder. Um, Anti-fragile are again things that gain from stressors, typically science and technology, and anything to do with innovation, not just science. Any business or any individual who is trying to think out of the box or innovate, making sure that their downside is low and their upside is wide open, is showing anti-fragile characteristics or behavior. So they gain from small mistakes, they learn the lesson fast, they course correct, and then they make a new high in performance. Fragile behavior is lecturing birds how to fly, almost in a continuous predicting sort of a mode. Bell curve mentality. So I need to do better than my peer, right? A typical fund manager, because they want to be seen as someone who is at the top of the quadrant or the performance, right? So if your NAV is continuously on display, you're looking at the scoreboard. You have to, and if you are continuously looking at this scoreboard, you are forced to act like cheerleaders because you don't want market to fall, because it will have a negative impact on an NAV, right? So you're more fragile and less robust, in my view. And then depending upon your temperament, your kind of client that you entertain, and your investment process, of course, you may be robust or more fragile. And then on the flip side, I mean, private investors, right? So they are more anti-fragile. So if you have seen Three Idiots, Funsuk Wangdu, he was an anti-fragile character. His downside was low, his upside was wide open. Um, R.K. Damani, Ashish Dhawan, all the way to Buffett and Munger. They all are anti-fragile because they keep their downsides in check and their upsides are wide open in whatever they do. And there are no hard rules for them. So they can sit on cash for ages and ages, and they can allocate disproportionately in a single holding because their NAV is not on public display all the time, or at least they are not feeling the heat. So the market volatility doesn't harm them, and if someone is on cash, they want the stock prices to crash because then they can the same amount of money can buy more, basically. So they deal with mental models and heuristics, almost a passive investor, SIP, right? If a stock is down, you get more for your bucks. And on the flip side, if the market is reasonably valued or overvalued, you can significantly reduce your SIP and wait for tide to turn, and then you can increase your SIP. So that kind of a behavior is an anti-fragile behavior. So if outcome is more important for you than the process, you are fragile. And then on the flip side, if process is the most important thing rather than the outcome, because you can never control the outcome. The only thing that you can control is the process. And then let's look at the Mudistan and the Extremistan. So the losses are all the Mudistans, right? So if you're suffering, you made a mistake, there is a loss, that's the downside. And in any investment, whether as an investor or a management, the three most critical things are probability, magnitude, and frequency. And it's the is the magnitude and the probability that are much more relevant and much more important than the frequency. And if you look at the what I call muddy stance, it's a higher probability. uh, they will happen more frequently, but the magnitude of loss will be lower. Classic case of drug discovery, right? If the drug fails in preclinical or phase one, a lot less cash is consumed compared to the success or the extremistan on the other side. So extremistans will be a very low probability event, almost a tail event, but very large magnitude. And the frequency will also be very low. So we'll find, large volume of mudstones and very, very small, almost a tail probability of finding an extremistan. And average is always mislead. when the dispersion is large, the averages will always be misleading. And here is a good example from the book Anti-Fragile. So Turkey has got all the data that the butcher will never hurt it. And in our context, in the context of investing, who's the butcher? It could be a regulator, USFD as an example. So that's all. And the other example could be a narrative fallacy, right? So oral insulin will work. That's a misconception, right? And you keep on investing in something, and then ultimately you fail. Competition or competitors again is an example of a butcher, because you don't know who else is doing what, and it's a competitive world, and it's highly unpredictable. So anything which is sort of hidden and anything that can harm us is a butcher. And when our downside is low and upside is wide open, we are kind of inverse Turkey. Um, so um, so we see the inverse Turkey, which is the other scenario. Inverse Turkey will never try to predict, um, and any business which is anti-fragile will try and hide the qualities. That's a very important characteristic to figure out which one is an anti-fragile business. So an anti-fragile or an inverse Turkey business will hide the qualities. It will expose defects. So pricing pressure. Whenever you think about pharmaceuticals or life sciences, you think about pricing pressure, you think about US FDA, right? So it's kind of exposing the defect and it's hiding the qualities. Whereas if you flip the coin, you think about banking as an example, um, it will be the opposite. It will hide the defects and display the qualities. So credit offtake, carnival kind of festival. So there's always a 3 to 4 year cycle when everything is fine. So you make small gains, right? So every year you're reporting gains, and then all of a sudden it could be game over, depending upon what kind of management is. Because banking as a business is a leverage play, 1:10 or whatever, right? So management becomes very critical, and regulation becomes very critical in any business such as banking. But fragility is not just specific to any business which is trying to predict on a daily basis, and doing capacity planning based on future predictions, which may or may not be true, and also leveraging the balance sheet. So it's a combination of things, right? So Nosil, as an example, when they doubled their capacity, and they were not banking on leverage or debt. Compare that with something like Piramal, or Biocon, or the downfall of Wockhardt as an example, or the previous avatar of Orchid Pharma. All of those, that was one of the major reasons, but there were other reasons as well, which we'll see. So all that is a fragile Turkey problem kind of scenario. And and here is another example of that. So uh, Turkey has got this mindset that this butcher is working in the best interest. So humans are very friendly because you've got statistical data. You've got data because you've been there. Butcher has been taking care of you since your childhood, and you almost feel comfortable with that kind of a news flow. And you have got no intention, or you just blind spotted that there are hidden risks, because history is hiding you, hiding all those risks, is hiding the black swan, which is the Thanksgiving in this case, right? So any business can have that kind of a scenario. Is the error of confirmation. So NED is not equal to END, which means it's a common term in medicine and pharmaceuticals. NED means no evidence of disease. So no evidence of disease is not evidence of no disease, right? So narrative fallacy. Risk, the real risk will always be unseen. It could be competition, it could be cheap signaling, data integrity and falsification. We've had many cases with the USFD, and the businesses have been obliterated almost. Again, classic example is Wokhart, right? From Chikalthana to Valuj to Shendra, all the way to Morton Grove in the US. Um, on the other hand, I mean, Global Trust Bank in 90s had the trust of institutions, right? Most of you will not know or remember this name. So this was a one of the earliest private sector banks in India. It got listed, I think, somewhere around 1994 or mid 90s, and it was doing great initial years, and the data was very positive. And all of a sudden it was game over. I think Ramesh Gelli was the MD, if I'm not mistaken. So I was one of the investors, and I had that mentality that whenever the stock doubles, you have to sell. So I sold Global Trust Bank on that template, and I also sold HDFC Bank. So imagine my loss today because I was following the simple template that the stock has doubled, you have to sell. So I was saved in Global Trust Bank, but had I done nothing, the downside of Global Trust Bank would have not impacted me today, because the upside from HDFC Bank would have compensated me, many hundred times. Work hard in 90s was a beautiful business. Was one of the so Mr. Habil Khorakiwala was one of the best strategists and one of the best managers. I've seen that business. So I struggle to imagine work hard of today, because I've seen that business in 90s. I've seen in early 2000s. Ranback C, I mean, they were one of the first ones to start the ANDAs around 2000s. But then Thanksgiving happened, right? And a lot has changed. I mean, Wokhart was a beautiful business. They had Wokhart hospitals. People never knew who the lead doctor was at that hospital. Wokhart Cardiac Hospital was known by the name of Wokhart. And they had great brands like Proteinex and Farex, and but then this obsession with NCs, and there was an 1800 crore of hole in the balance sheet. So their finance team, they were playing with future and options or derivatives in those days. And then there was a big loss of 1800 odd crores, and then in those cases you sell what you can sell. You only sell where there is a buyer on the other side. And all the beautiful assets that Wokhart had were sold one after the other. And then came this US FDA wave of non-compliance, and US FDA just took them out completely. And I think, given the level of non-compliance, I don't expect things to revert back to as far as the US FDA side of things are concerned for Wokhart. But again, never say never. But let's see. I wish them all the best. Uh, so Turkey behavior is, I've experienced many hundred or 200 baggers as an investor, so I know what I'm doing. And then as a company, we have a clean FDA records for decades, so we are all good. That's a Turkey kind of mindset. And I have seen very few Amgens and Genentech, but I have seen hundreds and thousands of Amaris, Zymergens, and small biotechs failing, right? So Extremistan is very rare, low probability. Mudistans are very common, high frequency event. And in Extremistan, right, is the inequalities are such that one single observation can disproportionately impact the aggregate. That's what we need to understand. And past is always surpassed, believe it or not. I mean, before 9/11, no one imagined that 9/11 is possible. When the TMT bubble was at its peak in late 90s, the PE of 200 and 300 was seen as inflated. But look what happened in the new age IPOs very recently. That PE of 200, 300 was surpassed. And so that's on the downside of past is always surpassed. But on the flip side, we have seen semaglutide and crass mutations were almost undruggable. And Syngene cracked it working with Amgen, right, recently. Deuteration chemistry, I mean, for decades, there were no drugs coming out of deuteration chemistry. So Austedo was the first one. So these are very rare extremes. that have happened. Moving on to so this is from Peter Thiel's very famous book called 0 to 1. And what I'm trying to do is analyze what's there in that book in the context of life sciences and innovation. So think about a small um, versus large players. So small businesses, small biotechs, they are much more innovative because they 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 have no red tapes. They have no unnecessary sludge, right? And then they innovate. So Karuna Therapeutics as an example, and then they end up being acquired by big pharma. Pfizer, another example. So they recently acquired a cancer biotech, I think Seagen, and they paid somewhere close to 43 billion for that acquisition. So small businesses, they are more risk taking, and they are agile, and they innovate faster and better. And when everything is uncertain, you just cannot plan. So there will never be sort of any plan, because future is so unpredictable. You have to almost adjust to whatever scenario or whatever problem is thrown at you. So you start with an existing customer, maybe one molecule. You just try it out and see how it works. So you're just almost playing with optionality, low downside, large upside. So if it all works fine, um, your upside is all yours to capture. If it doesn't, and most of the times you will fail because you're trying to do something new, but your downside will be very limited. Um, and then Peter Thiel says that technologies are primarily about product development. And if we look at the life sciences outsourcing industry, who is developing is the CDMOs, right? So they develop, they manufacture. The core purpose of the big pharma is and end market, marketing, sales, distribution, right? So development and innovation, I expect outsourcing to increase further, because technology, as Peter Thiel said, is all about product development and not distribution or marketing, because your product should be such that you don't need to market it. uh, and again, on the flip side, we have got a commodity example. So your business can die and not make any impact. That means um, it's a pure commodity. A chemical company, let's say DMCC or Nosul, they can die, and they will not have a significant impact in the wider ecosystem. But imagine a financial institution. So small banks, they die all the time, and they get acquired by big institutions, big financial institutions. But what if a big financial institution fails? They will impact the entire ecosystem, right? Not just their customers, in terms of, if it's a retail bank, the fixed deposits and all the rest of it. There is a whole ecosystem behind them, right? So the death of the business doesn't matter if you're a pure commodity. Large financial institution is an exception, because governments, they don't let them fail, and they invariably get a bailout. uh, and monopoly owns its market. So if you are a patent protected molecule, a supplier of patent protected molecule, you are the master of your destiny. So you own that market until that patent is and until that molecule is patent protected. um, and all happy companies, Peter Thiel says, are different because they've got this monopoly kind of situation. All failed companies are same. So if you are unbranded commodity, many companies are doing statins as an example. Then it's all competition based, and all failed companies are the same because they failed to escape competition. Network effects are also very powerful in the context of life sciences. The more customers and the more pipeline, and the more enrichment you have at your scientific team, the larger, the better, and the bigger your network. The word of mouth. uh, Economies of scale, very important. As the monopoly business grows, it gets bigger, because it's kind of your circle of circumference of touch points with innovators is increasing, right? And people keep moving companies, and they carry that memory with them, and that kind of a thing. Uh, then Peter Thiel says that most of the value of high growth businesses or low growth businesses near term, and high growth is further down, because if you see the drug discovery, it's a 10-year workflow. Delayed gratification is baked into that thesis, because most of your experiments will fail, and you have to wait for the value unlocking at the end of that workflow. So delayed revenue and delayed gratification. Um, Silicon Valley, he said in the book, that is obsessed with disruption, but disruption is all about technology and low-end product and low prices. So think about generics, low-cost generics, right? It's all about affordability. And so what Indian companies have done, they are now the dominant player in the US generics space. That's the true definition of disruption. And this is I think from page 75, I've recreated this. Um, Peter Thiel was trying to compare biotech startups with software startups across the parameters shown here, from subject all the way to team. And his thesis back then, so this was from his, the book came out in 2014, from his lecture notes in somewhere around 2012, 13, or maybe prior years. And he's saying that despite dramatic advances over the past 2 centuries in recent decades, so this was 2012-ish, biotechnology has failed to meet the expectations of investors. And he was right. And he's saying Eroom's law, which is the opposite of Moore's law, observes that the number of new drugs approved per billion and dollar of R&D has halved every 9 years since 1950. So, but that was then. There's a tide shifting here. And if you look at some of the recent research, so this came from London School of Hygiene, and they're saying that the cost of developing a medicine is getting lower now. And I believe that we've just started to scratch the surface here. And the reason I say so is because think in terms of probability and magnitude of optionality. So we are comparing 2012 versus now, and 2030. The digital biomarkers were not there when Peter Thiel was writing that book, or during his lecture days. Now we have got early detection and voice recognition, DCTs, distributed clinical trials. So imagine a scenario where a company in Ireland is conducting clinical trials in Latin America for a Japanese innovator. None of this was possible previously. Now it is, because technology is giving us that flexibility. And I think distributed clinical trials is a gift of COVID to mankind. RWE is real world evidences. Regulators increasingly, from EMA to US FDA, they are approving the real world evidences, and they are taken into consideration for the new drug approval. And last but not the least, the artificial intelligence and the machine learning, the protein grammar models. So now you are increasing the landscape of your screening universe, and you're doing it faster as well. And none of this was available back in the days of 2010, 2012 kind of a timeline, when Peter Thiel wrote that book. So a lot of shift is happening, and technology is only getting better as we are progressing. So what we'll find hopefully is, and that's what I've explained in Appendix A of my book as well, that um, the drugs should develop faster and cheaper, both. Over the next 3 to 5 years, we should start to see some of the early signs of this innovation. And I think that's exactly what companies like NVIDIA and others are talking about as well. Fail frequently, fail early. Why so? Because when you fail early, your cash burn is lower, and you get a large runway to compound your learning. And Peter Thiel says that um, we have to make a small incremental advances, and that's what innovation is all about. I mean, innovation never happens in a big bang. I mean, Edison said that I did not fail 10,000 times. I Those were those were the opportunities to learn. So science is never wrong. If an experiment fails, science is not failing. Science is telling the scientist or the stakeholder that this is the wrong pathway. You need to change course. That's the feedback science is giving in a failed experiment. And again, in terms of the probability of success, the goal is to eliminate or reject. So from preclinical all the way to commercial, 1 in 10,000. That's how low the probability of success is. And economies of relationship specific assets. Most people don't appreciate this. When you start a new relationship, you invest a lot more, but over time you start to get the benefit of that relationship. So your cost per transaction reduces significantly. So look at the Zoetis deal that Syngene had, right? So they started that relationship 10 years back, and no other company in India has got a 10-year disclosed in public commercial manufacturing arrangement. Forget biologics, not even in small molecules. So in that sense, is the economies of relationship specific assets playing out nicely for Syngene in this case. And then we have to look at affordable failures, anything that we could recover from. So as an investor, if I'm investing in a new sort of opportunity, I have to think in terms of, if I fail, what's my stop loss, what's my downside, and then as long as I'm comfortable with that downside, the upside is wide open. So I have to look for that convexity, low downside, large upside area. And likewise for managements when they are planning a new projects. And it's a game of kissing frogs. The drug discovery or innovation in general is a game of kissing frogs. What we need to understand as investors is, which frog are we kissing? Is it a frog in phase 3? Because then the probability that this frog will turn into a princess is somewhere in the region of 55-60%. If you are kissing a frog in preclinical, forget it. 1 in 10,000. And likewise for phase 1, going to phase 2, and the probability is 50%. And all of these probabilities, they multiply. And that's the reason 1 in 10,000 gets from preclinical all the way to commercial. But from phase 3 onwards, the probability is much better. So if you have got 10 frogs in phase 3, it's very likely that you will get more than 5. And that's the game. Late stage molecules, late stage pipeline of molecules is what we need to assess as an investor. And also companies also actively target innovators that have got a pipeline of late stage molecules. And likewise, innovators also want a, a reliable partner who could take that molecule successfully into commercial. So it's a two-way street. And heads they win, and tails you don't lose. The only scenario that can happen is if in a service model. So your scientist is billing just like IT services. You're conducting a research on behalf of an innovator. You're part of that team, you're collaborating, and innovator wants their R&D dollar to burn slower and longer. So they want to partner uh, with someone who has got a rare combination. It's a very rare combination to find 3C at scale. So capability, compliance, and cost at scale. So India and China are not the only low cost destinations, but perhaps they have this unique advantage of offering 3C at scale. So how many countries, including Vietnam and Thailand, can bring all three together? So capability, compliance, and cost, and do that at scales. Can you hire 500 scientists in a country like Vietnam and Thailand? You can of course get 10 or 20. So scale is the big advantage when it comes to China or India. And fate sur mesure or made to measure advantages, again, economics is in the specific molecule. um, Same company maybe. So if I take Newland Labs as an example, the economics of levetiracetam and the economics of palperidone palmitrate sterile, or the molecule that they are developing and manufacturing for innovator, in all three cases, the economics are very different, right? So it's a combination of the economics of a specific molecule, the compliance culture, capability, um, the relationship that you have with the innovators, all that, and the optionality that you have, pharma, non-pharma, because CDMO is not specific to pharmaceuticals. I mean, Loras as an example, they are almost 360, and Syngene as well. They are not just targeting one specific therapeutic areas. They have got small molecules, large molecules, all the sorts of chemistries, new age innovation, CAR T, precision medicines, all of it. So there was a quote from Warren Buffett. If you go back, I think it's about 25 years back. He said, "A bird in hand is worth two in the bush." That two has become 10 now, inflation adjusted, right? So, so tongue in cheek. But the important framework is you have to look at the probability of failure and time adjusted payoff. Um, so i- imagine high failure, but if the failure doesn't come, I'll get extreme cash. So Russian roulette as an example. I don't want to play that game. There may be a 10 billion reward playing that game, but what if I'm wrong? What's my downside? Downside is zero. I die. So I don't want any investment or any game where the probability of failure is high, and I don't care what the payoff would be. I want low probability of failure, and time adjusted payoff should be decent. So 20% compounding over 30 years is preferred over 70% compounding over 2 years, with a huge downside risk that I may lose everything. Uh, Moving on. So this is a classic example. So when I was creating this slide, I had US biotech on my mind. I also had Indian companies like Wockhardt, Suven Life. So I discussed this model with Mr. Venkat Jasti of Suven Life, and he agreed that that's the right sort of thinking, because your book value of 1,000 crore investment, when you adjust it with time, if you take opportunity cost of capital as 15%, over 20 years is 16 bagger, and 20% opportunity cost of capital over 20 years is 38 bagger. So if you are doing, so work hard as an example, if you are investing for 10, 15, 20 years, even if you get a blue sky outcome, what's your time adjusted payoff from a return on investment perspective? Because if you have invested 1,000 crores over 20 years, you could have invested those 1,000 crores periodically in a Torrent Pharma as an example. And that business over 25 years, if I'm not mistaken, Torrent Pharma is a 500 bagger. So you have to take the opportunity cost of, how much cash you injected, how long have you waited, what was the probability of failure, or is the probability of failure, was the frequency of failure, all the rest of it. And then you need to decide. Some of the mental models. So again, management is the key ingredient here. In my view, management is the 99%. And I go for a TC, which is trustworthy, competent, capable, and high energy. I want to play that combination, because the future is uncertain. I don't know what I don't know, and even management is unaware of that. But as long as the management is agile, flexible, competent, and trustworthy, they will figure it out. So Wipro wasn't an IT company to begin with, but Azim Premji had that TCE characteristic, and he created wealth. So that's and I've explained, in a series of lenses in the book, what kind of mental models are specific to life sciences, not just life sciences, any innovation for that matter. And and people forget that management on a daily basis is making thousands of decisions, or an annual basis is making thousands of decisions, and not every decision is within the remit of stock exchange filing. So we don't know what they're doing. So we need that element of trust, and we need to believe in their competence and capability and their energy levels to sort of make the dollar compound at a rate which is reasonable or within sort of our expectations as an investor. And 20-25% long-term compounding, I think, is my expectation, and I think that's as long as I'm getting that over a period of time, I would be very happy. Luck, I think, is very important, but we have to design the door large enough so that the luck could easily enter. And if I'm buying low, then I don't need to predict, because the upside is wide open. And my framework of margin of safety is beyond valuation. It's also about having an anti-fragile management and an anti-fragile business along with low valuation. The combination of three is what I've explained, is the margin of safety. And if you read that book, it's a brilliant book, Thinking Fast and Slow, from chapter 17. Luck is a very important criteria area, and I want to position myself in scenarios where the resources and capabilities in terms of the management and the business are either average or above average, and they may be unlucky at times, but they will also be lucky at times, and on balance I will get a very reasonable, healthy outcome. So the role of luck in an unpredictable world is often ignored. When you are winning, you think it's your talent. No, it's never. Luck is supreme, and they are count. So a great management will not let many accidents happen, and we may never know about them. We only know about the accidents that actually happen. So if I'm hit with 100 different sort of challenges, and if I fail on one or two, those will make the headlines. But what about the other 98, 99, which I avoided successfully? Uh, 50 shades of common sense. So again, this is a Russian roulette example, which is again a turkey behavior. 5 out of 6 times, it went fine. So you have data. You are able to predict that future is very certain, and you're winning all the time. The first time you win, all the 5 instances would lead to enrichment, says Taleb, and then one would lead to a statistic, an obituary in this case. So always as an investor or a management, you have to look down first. What's your downside? And resist the lure of the hindsight, or the illusion of uncertainty. Uh, Again, avoid narrative fallacy, as Kahneman and Amos Tversky have said in that book. Um, Narrative will fool you. And number has to be a function of narrative, but also narrative has to be a function of numbers, and both must match. Both must match, and even then, because the future is unpredictable, you cannot take it for granted that the status quo will remain. You have to almost continuously track how the situation is evolving, and is management kind of getting into this trap of a turkey problem. They're trying to predict an uncertain future, and that would be an alarm. And in an uncertain world, an anti-fragile business will gain from economies of learning. So if you're not learning, you are not anti-fragile. You have to learn from your mistakes, and then you emerge as a better player in a disruptive world. And then your economies of learning improves your probability of success. And it's all about rules. I mean, this you if there are hard and fast rules, then algos and software will take over. The humans as investors will fail to exist. So it's all about heuristics. And if you read Thinking Fast and Slow again, I think heuristics have been extensively covered in that book. Over 100 different examples and illustrations of heuristics in that book from Kahneman. Uh, and ownership mindset is also very important, because I have to almost believe that I am about to buy this whole business. And if when I go with that kind of a mindset, I value the business very differently. When you think about you're buying a stock, you value that business very differently because you're buying for tomorrow. But tomorrow you cannot predict. So you have to almost think like an ownership. And I prefer managements that have got skin and soul in the game, who are the owners, because then they can make the difficult decisions that will give us fruits 10 years out, 5 years out. uh, our rental management, quote unquote, rental management is someone who is there for 2 years or 3 years, and they've got salary in ESOP, rather than the skin and soul. So they can never, by definition, they can never make hard decisions. So they are forced to make near term decisions because they're looking for certainty. And in an unpredictable world, you cannot control the outcome. So, and I think India as a country is blessed because we have got so many owner operated businesses, which is unlike Europe or US. So again, this is a very complicated picture. I have explained the various nuances of this across the lenses. So this is our distilled version of chapter 8 and 9 actually. And very quickly, I mean, I'm thinking in terms of the gross margins, the asset turns. So greenfield versus brownfield. Think, what could be the asset turn, the gross margins, with the improving product mix, and what does it mean for the likely asset turn 3 to 5 years out. So this is from the portfolio construction point of view. In an uncertain, disruptive, unpredictable world where we don't know what we don't know, the knowledge is either not there or incomplete. Um, we are having a tug of war between the lumpiness in the cash flow and the unpredictability of the outcome. And on one extreme, we have these three, four examples of a single molecule biotech innovator, big pharma, a pure play CDMO like Syngene or Suven as an example, or Lonza or Thermo Fisher, though Thermo Fisher is not a pure play CDMO. They've got several other streams of businesses. It's a large business. They've got about six billion or thereabout free cash generation every year. But then again, their cash flow from CDMO services will always be lumpy and unpredictable. So the first thing that I look for when I'm constructing a portfolio is the business, can this business sustain without external funding? And if I think about Spark or Work Hard or maybe Suven Life, there is no operating cash flow. So they're relying on external funding because the business is not self-sustaining. And those kind of scenarios I want to avoid. I want business which is generating positive operating cash flow. May not be every year, but in a 5 year kind of a timeline, the operating cash flow should be meaningful and material. And then I also look at management's thinking. Is management thinking short term or long term, and what's their track record? I don't care what kind of promises they are making today. I care about, what has been their track record in the past. And what are those sort of uncertainty balances? So compare hybrid CDMOs with a pure play innovator CDMO. A pure play innovator CDMO is banking exclusively on the management getting the right side of the science and the innovation, because they have got a set of innovator molecules. But innovators may pull the plug tomorrow, or the molecule may fail. So you don't have 100% control over your destiny. Whereas if you are a hybrid CDMO where you have got your own generic products in addition to innovator synthesis, at least you control part of the destiny. So generic cash flows are much more sustainable. So you're almost balancing uncertainty with lower uncertainty. So you're mixing generics with innovator synthesis. That's the model of hybrid CDMOs. And if you look at Laurus Labs or Newland Labs as an example, they have got both the generic elements in the business as well as the innovator synthesis. So I prefer, or at least a lower sort of risk and lumpiness in the business. So Syngene, for example, when the US biotech funding started suffering, their growth rates have slowed down, right? Because they get a large proportion of cash flow from early stage drug development, so almost preclinical and early stage phase one type of thing, which is predominantly biotech, small biotech, and a large share of their customer pie is in that sphere. And when there is a crisis on the funding, no one would let go a late phase 2 or a late phase 3 drug, because that's kind of, you're kissing that frog, and 50 to 60% will convert into princes. So whenever there is a funding crisis, you get rid of the lower probability molecules which are early in their clinic, rather than disturbing the late stage or already commercial molecules. And from that predictability perspective, the businesses such as, so at the bottom of the pyramid, anything which doesn't require financing or funding from financial institutions, so very small ticket consumption, that's very sustainable. So if you're creating a portfolio, you have to have a mix of sustainable and less uncertain elements. So consumption and OTC as an example, or medical equipment manufacturing. So Stryker as an example, again, no recommendation. And branded generics. You see the cash flows that even these diversified businesses like Sun Pharma and others get, or Glenmark for that matter. The ROC and the cash flows that they generate from their branded business, not just in India, even in emerging markets. So the Lupin will carry the same brand, or Ajanta Pharma, for that example, is the same brand that they are selling in India, they are selling in emerging markets. So is the stickiness in that brand that is coming from, in that molecule that is coming from that brand, and it's sustainable cash generation, unlike the US generics where you neither control the volume nor the price. So you have to have a mix of, by all means, have one or two biotech. If you have got 20 stocks in your portfolio, I mean, that's what I do. I keep 5 to 10% at the extreme end of lumpiness and unpredictability, but I also want to balance it out with a set of hospitals, branded generics, and consumers, so that I'm not hostage to. So I don't want to predict anything. I want to be in inverse turkey situation where time, the most underappreciated factor in all of these is the time, and time is the necessary ingredient in compounding. I tweeted something on time, and I honestly believe that if you take compounding, whether it's Warren Buffett or your own sort of, you look back. So Newland is a almost a 200 bagger today, dividends included. When I first bought it, it was a 50 crore business. I remember in March 2004, and they've had several Mudistans in 2010 and again in 2018, and it's well documented in the annual reports. Despite all those Mudistans, today the business is where it is. And why it is so, is the time and the fact that they learned all the lessons. Is anti-fragility is there in the management, right? They made the mistake. Luckily they were small mistakes, um, and they course corrected. So time is very important. The drug discovery workflow is a 10-year workflow. It's again function of time. Worst molecule will consume all the cash over the 10-year cycle, and then they will collapse. So they will take all the cash and then they will not be successful. That's the worst molecule. Good ones are those that are successful, but also those that they fail very early on and give you invaluable learning as a scientist or a management, that this is not the right pathway. We need to course correct. So those are those are the examples, and that's why several mud stance is good as long as your downside is capped, and you understand your stop loss, you don't bleed that much, and you get one, or you only need two or three successful outcomes in 100 experiments or thereabout, right? Even two is more than enough, if you think about the downside versus the upside, and and you need to survive. So time again, you have to, a business that is able to survive will grow. The first condition is you have to sustain, and how you sustain, you need operating cash flow, you need a source. From an investing perspective, if your entire income is market dependent, then you are fragile. If you are having a source of passive income or a salary, it could be rental income, it could be dividends from stocks, it could be you're doing a job, part-time, full-time, you're getting some sort of steady stream of cash coming from that source, you are you're much more anti-fragile, because you're not dependent on the outcome of the market, and you can be much more patient with your trades. And this is a beautiful example of a large risk versus a small risk. um, a king angry, so I'll let you guys have a quick read, and then I will explain what it means in the context of investing and other things. So think from regulatory compliance perspective, right? US FDA audit, you can, over a period of 30 years, you can get 100, 200, 300 small observations, small pebbles. They will not hurt you. But if you do a Chikalthana or a Baluch, your business may be obliterated. So that's the large stone example. I mean, make small mistakes, those mistakes that you could recover from. Large mistakes that you cannot recover from, those are the ones that we need to avoid. And from our investing perspective, don't make a bet, and don't buy a significant percentage in your portfolio when the stock is doing fine, the news flow is positive, the near term earnings have been in momentum, and the stock is making new highs, and you bet 50% or whatever of your portfolio in that stock. That's kind of inviting a large stone. And then this is the big picture. The world is sort of uncertain, right? And what I'm trying to explain here is that, and again, this is the model that I have explained in the book. In an uncertain world with lots of volatility and lumpiness, the what I'm trying to explain is the antidotes, or the firefighters, as they say, right? So have multiple optionality, and have significant margin of safety, and have some sustainable source of existing cash to sort of fund those optionalities. And then keep innovating. Higher the uncertainty, the more valuable and the diverse range of optionality you need. And higher the uncertainty, the higher the opportunity to learn and innovate, and possibly create large positive outcomes over time. And what I mean by optionality in the context of life sciences is, so take hybrid CDMO as an example. You need many generic products, many customers, many NCE projects, many facilities. So your manufacturing footprint should be well diversified and spread out. Multiple scientists across multiple therapeutics. All these are sources of optionality. Fungible capacities. So Newland had struggled that in 2018, where their capacities were not fungible. They course corrected, they learned the lesson. Today their capacities are fungible. So all that adds to the optionality in this case. I think that's about it. I'm not sure about time wise, how much time I have consumed. I've got no idea, but I think we are ready for Q&A.
Okay, thank you, Sajal. I guess, I mean, I think when the conversation is so engaging, you're all ears, and clearly your passion in the topic as well is very visible. Building an anti-fragile portfolio. And I think, I'll not speak more. I'll just tell all of our viewers that the book that Sajal has written, the entire proceeds go towards an altruistic purpose. He's not going to be getting home a single penny. He's only going to be looking for anti-fragile portfolio options to really make his money, essentially. And, I would like to use this platform as well to say that, please, of course, Sajal has shared his, choice of non-profit that he likes to support. But, please, use this opportunity as a nudge, as a reminder from us and from Sajal especially, that, please do go ahead and contribute whatever you can towards, a non-profit or a cause of your choice. So yes, without any further ado, we are going to take on board some questions, and I'd request SOIC Finance as well to allow the participants and the panelists to be able to post their questions on the webinar chat. We already have a couple of questions actually very relevant to what you have been speaking about, Sajal, about the Indian CDMO industry. I guess it's a little relatively newer, but what, there's Neeraj Shah who's asking this question. And he says that, investors feel a bit dejected when investing in longer gestation businesses in this space, and often believe that the eventuality will or should be this linear growth line, and in India of a very low base. So he's asking you, what mindset should investors have when choosing a CDMO business, and how to identify which one has a higher probability of success?
Right. Very interesting question, and very, very loaded question as well, I must say, Neeraj. But I don't expect anything less from him. He understands this space. So if I take this question, break it down into bit by bit, in terms of dejection, so it depends on what kind of investor you are. If you are a public fund manager, if you have got a large allocation in, let's say, Lotus drops from 700 to 300 or wherever, you'll feel the pain. I mean, because your NAV is taking the hit, NAV is on public display, right? So you will feel it. But if you are an anti-fragile investor where your NAV is private, or you want to add more to your existing position, I wouldn't feel dejected. I would be happy, because then imagine, so again, Lotus as an example, 2019 the stock was 65. If Even if I look at today, right, stock is nowhere near its all-time high, but my compounding is pretty decent from December 2019. And if the stock has crashed, so Newland, another example, many would have struggled to see it crash all the way from 27,2,800. There was dejection when it came all the way to 1,000. But then it's also giving you an opportunity to buy more for the same amount of money. Dollar cost averaging. So again, dejection depends whether what kind of time frame you have. If you have bought something for 6 months to 12 months, I'm not sure if CDMO or life sciences is a sector to play for that short a horizon. But if you've got a 5-year plus kind of an horizon, then I think by all means you will get several modest stance, but you will also get 1 or 2 extremist stance, and overall your outcome will be very healthy. Was there any other part that I missed in that question, Rubina, that I haven't answered?
No, I think it's mostly just about the mindset, and you attack that very well. That essentially you have to have a
Yeah,
longer term time frame. Don't
absolutely.
look at this business if you just have 6 to 12 months and want to get your money out. And I think Neeraj's question also had the word long gestation. So it was kind of,
So the workflow itself is a 10-year long workflow. So
yes, yes.
there is gestation baked in. So you take the hit upfront. You'll be
Yeah, yeah.
building capacities and capability. You will lose on your operating. So operating deleverage will come into play. But then when the upside, so it's like convex behavior, as Taleb has explained in the book Anti-Fragile beautifully. It's the convex behavior. It's almost a J curve kind of a thing.
Okay, he's just got a couple of more questions. And, for the sake of answering everyone's questions, I'm just going to quickly club them up because these are very relevant again. That a lot of these CDMO companies have obviously very large global biotechs as clients. They have lent a strong pipeline of drugs to these CDMOs as manufacturing partners. Do you see this model scaling up? And also, just for the sake of clubbing it, and I see that some questions that we've got also do have the same questions. What are the non-financial factors Again, something that's easily available to the market and investors, which may help an investor differentiate a good CDMO from a great one?
Yeah, sure. So again, very sort of loaded, interesting questions. In terms of the opportunity to scale up, I think the opportunity is huge. If I look at my own experience of dealing with the likes of Newland Labs, over a 10-year period, they have significantly expanded their base. So this was a 10 crore, 20 crore business, the synthesis business, and today it's 400 crores over a period of, let's say, 10 years. So if you go from 20 to 400 over a period of 10 years, that's a significant scale up. And India as a country has got that 3C at scale advantage. So I think, over a period of time, we should be disproportionately benefited. He also asked about non-financial factors. So um, capability is one non-financial relationship with biotechs. If you are adding more customers, you are adding to your capability either organically or inorganically. So Laura's buying Richcore was an inorganic move. That adds to their capability on the biocatalysis and the fermentation side, as an example. So almost a pipeline of optionality, your track record over the last 5 to 7 years. But one, I'm not sure whether it's a non-financial, one metric that I could give investors to track is how has the gross margin progressed over a 10-year period? Because if you are moving up the value chain in terms of higher complexity, and if you're doing more CDMO, then your gross margin should start to trend upwards, not on a year-on-year basis, but take it in a blocks of 5 to 7 years, and you should see that rising trend.
Okay, we have a very interesting question directly related to, speaking about anti-fragility. Rohit M has asked, how do you look at companies that are in phase 3 of new molecule development? The fact that probability of success significantly increases during this phase 3, and that's something that, your table as well indicated. They don't have any history of success. And also the expected payoff can be significantly higher than the price you are paying for the business. And also the event outcome is around the corner. Again, he gives the example of work hard. So essentially, he's talking about, assessing companies in phase 3, when in many ways, there's probability of success as well, but then events too can, hit you very hard.
Yeah, I think again, look at the operating cash flow that the business is currently generating. What is the mix of things? What other businesses they have, and what's their cash flow dynamics on the other businesses? Wokhard, as an example, if they have invested X amount of money over a period of 20 years, if you take the compounding at 15% over 20 years or 20% opportunity cost of capital, from that perspective, even if you get the success, how big that success would be? Will that be a one-off success, or can you follow it up with a pipeline of 20 other molecules and put together, you could create, a cash flow of $2, 3, 4 billion over a period of time? Then that would be significant and big enough to justify the investments over 15, 20 years. So that's important. I prefer companies. So Sun Pharma, as an example, they demerged their innovation spark, and shareholders are not paying for that innovation today. I prefer that kind of a model. I would urge every generic company to demerge their innovation, so that depending upon what kind of investor you are, you could participate in either or both of them.
Okay, remember, folks, we're trying to take more and more questions on the topic, and that is, building an anti-fragile portfolio in the life sciences business, in the, the pharmaceutical businesses, in the biotech business. I am going to take a question on, Suresh, that Suresh has asked. He says, in the current market, could you share some indications or some, well, he's directly asking you actually for the business name, so it's your discretion whether you'd like to share that or no, but maybe you can start with a guide at the current market share, some anti-fragile management businesses to study and how to get the correct valuations.
So again, valuation is a combination of the management, the business, and the financial metric of things. The framework that I shared, you look for sustainable sources in the portfolio. So have a mix. Don't over bet on one specific business, especially when the outcome is uncertain. Have a mix of consumer stocks, branded generics, maybe one or two hospitals, maybe a care home as an example. Because I believe many people say that India is a young country, but India is also an aging country. If you think from a second level perspective or a second level thinking, how many people are crossing the age of 55 years in India on an annual basis? So there is a senior citizenship, or senior living kind of a pie which is increasing on a year-on-year basis. So you have to have that kind of sense. I mean, there are many examples that I've shared in my book, which is again my perception based on the data that I have seen. But again, I may be a turkey myself, in the sense that it's an unpredictable world. What I believe is an anti-fragile management today may turn fragile. So I'll again give an example of work hard. In 90s, Mr. Khurakiwala, when he was leading, it was an anti-fragile management. And then all of a sudden everything went all over the place. There was a balance sheet hole in 1800 crores, US FDA challenges and all the rest of it. And as long as you learn from those mistakes, and you could almost rise like that phoenix bird from the ashes, it's very difficult to course correct. Orchid, another example, the previous management was fragile, right? This new management is getting the rewards of the previous. So this enmetazobactam was not the creation of this existing management. They've been lucky, and they've been gifted this NCE, right? So again, luck is something that if you build the door large enough, luck can enter.
All right. Let's talk, about the point with respect to adaptation. I think this is something that you briefly alluded to. Shubh has a question relevant to that. Shubh asks that with the rapidly changing technologies and the processes for drug development, how do you evaluate whether a company is using or adopting the right technologies for its product portfolio, staying relevant constantly, maybe infusing the resources required in its R&D department? How do you assess something like that?
So I look for fungibility. So if a scientist is a fungible unit of growth, a scientist working on one experiment, if the experiment fails, the same scientist can be deployed on a new experiment or a different project. So I look for sources of fungibility, not just on the manufacturing side, not just on whether the reactor itself is fungible, that you can have 10 different molecules manufactured in the same reactor. I look at the softer, so processes and scientific capability. If that is fungible, then they should be able to adjust and pivot depending upon what the future throws at them.
Well, here's a relevant question. I think when we talk about CDMO, we're thinking, okay, the world's big pharma companies are adopting this entire China plus one policy. They're looking towards India. So clearly China, Chinese CDMOs didn't really have a very anti-fragile framework in place. So SA is asking, could you please discuss the CDMO landscape in India versus China using anti-fragile framework?
Right. So I think China is like that fragile country, if I'm not mistaken. There is an electromagnetic field, and people are forced to comply because it's like that molecule operating in that electromagnetic field. So instead of that Brownian motion zigzag, because that electromagnetic field is there from the current ruling party, you are forced to behave in a certain manner, which kind of, and that's a sign of fragility. Fragile things ultimately break. We cannot time. It may be 10 years out, it may be 5 years out, it may be 20 years out, it may not happen in our lifetime, but fragile things always break. So from that perspective, I think China plus one narrative is now China minus narrative, if I'm not mistaken. Because my interaction with companies both in India and outside India, the innovators are getting increasingly worried about their over reliance and dependence on a single country. And they also don't want to make India another China. So they want to diversify. So part of that molecule pipeline will also go to countries like South Korea, where they find that 3C at scale combination. But I think is China minus is the new narrative. People are consciously diversifying away from China, but also Europe plus one. Europe is looking for a combination of affordable and accessible innovation, and India is a natural kind of or an emerging partner for many of the European companies right across Germany, France, and Italy, and in UK as well.
Okay, we've got a couple of questions on the CDMO business model in India because there are several business models. There's CDMO plus formulation versus pure play, then there's CDMO generic. So let's talk about how you assess each of these and how each one's business model works, the pros and cons. There are some with very few scientists, some with really large really large scientific sciences bucket as well, pardon me. So how are you assessing all of these different business models?
Yeah, so as I said, I prefer hybrid CDMOs over pure play. So I want a mix of generic and innovator. And I think every business, if not today, will slowly pivot into this hybrid mode, including the pure play ones. So if I take Suven or Syngene as an example, they are largely pure play innovator because they haven't got much cash flow coming out of the generic molecules. But slowly my expectation is, and I'm not trying to predict the future, it's a natural outcome that you will participate in the generic opportunity. And I think Stellis, which is the CDMO arm of Strides, will also, I think predominantly they will look at the generic side of things, because even in generics, Divi's as an example, you get 30-35% steady state EBITDA on full scale up or full ramp up. So that's not something that any company, the kind of economics that they get even on the generic side, because the relationship is for that specific technology and that specific molecule going to a specific innovator. So you do get 30-35% operating or EBITDA margin even in generics. So I think if I look at the Mangalore API filings that have been done by Syngene, they are targeting generics. At least the filings are telling me that they are potentially looking at generics as well. And the reason is that they should be able to garner 30-35% margin even in generics. Innovator margins on full scale up could go as high as 45-50%. But the question is, will that margin be sustainable, because the molecule at some point will go off patent? So you need to have a mix of both.
Ameya is asking, do you not think that managements might slow down, on economies of learning as they scale up and, get more comfortable with visibility in the business? Is this something, that you witnessed, perhaps a case that happened with Wockhardt?
Yeah, so I think if I am in charge, if I'm the decision maker, I would make sure that the demerger happens progressively. So Jubilant Life Sciences is an example. They started with VAM Organics in 90s. I'm not sure whether people know that name or not. Then VAM Organics became Jubilant. It was Organosis. Then Jubilant Organosis transformed into Jubilant Life Sciences, and then they demerged into and Tata Motors is an example. Today I heard that news that they are also demerging. Not a life sciences play, but small is anti-fragile, as Taleb says. So the larger businesses are difficult because you invariably get red tapeism, and there is a corporate sludge that builds. When you demerge, you're more lean and flexible. So I think as long as every 5 to 7 years you carve out ventures and you split them out, you demerge them, you keep the innovation pie growing.
Okay, all right. We've got quite a few questions actually on individual stocks
Right.
too. Sajal, if you permit, may I ask them?
Maybe just fire away if I can.
All right.
I mean, if I'm not invested in those stocks, I'll definitely give my opinion. The,
So
the, the
advanced
harder the
enzymes.
harder bit is,
Let
if
me
I'm
just
invested, then I become biased.
Yes, of course, fair enough, and it's in the interest of everybody for that. So advanced enzymes, that's actually the stock that everybody wants you to analyze, and especially from the entire anti-fragile point of view.
Yeah, so I think it's an easy one for me because I've been tracking advanced enzymes since the IPO, and the stock has not done much. And I was convinced on the enzymes gaining market share because a lot of chemical molecules or backend is slowly transitioning from chemical which is fossil derived, fossil fuel based, into this sustainable bioenzymes, biocatalysis world. So I was convinced on the runway of advanced enzymes. And valuation is something that I can understand, I can calculate. So those two things I was comfortable with. And the whether the business is anti-fragile, the answer is yes. The valuation I control. I wasn't clear about the management, whether this management is anti-fragile. And for that, in that, Pulak Prasad, the Nalanda Capital, they helped me. So in his books, if you read Pulak Prasad's book, the new book, which is what I learned from Darwin, he has explained not just advanced enzymes, but many businesses as part of the framework that they follow. And he validated the management, and the stock was somewhere around 370, 380. So I initiated. So management was the missing link in my sort of jigsaw puzzle, which fortunately for me, Nalanda Capital solved that puzzle.
Okay, hospitals, Sajal, I mean, we've been seeing increasing vulnerability to regulatory risk over there. There was this recent Supreme Court diktat as well, asking to regulate pricing, etc., of different procedures. So how do you shortlist anti-fragile hospitals, among, of course, the listed lost? And, what kind of
I think
ratios?
all hospitals, if you track them over a 20-year period, they have demonstrated clear anti-fragility, and regulation has to be there. See, India is a relatively poor emerging market where you need affordable and accessible healthcare. The volume should take care of your fixed cost rather than the pricing. So in that perspective, I think is there. And again, I'm invested in Narayana hospitals as a disclosure. Their venture into insurance is an anti-fragile strategy because their downside is low, and if it works out fine, then over a 10-year period, the upside is wide open. So that's one of the examples of the anti-fragile move. But again, the disclosure is not a recommendation. This stock has run up a lot.
Okay, Sajal, we've got plenty of questions, not necessarily all related to anti-fragility. Many want to know your view on stocks, etc. So I think I'll just take a couple of more if
Sure.
you'd permit. Um, if one wants to play the long-term decadal CDMO trend to make the odds in their favor, what basket, or rather, what is the approach one should take? Many have spoken about Loris, Newland, Syngene, Strides. These are, of course, the go-to CDMOs. But how would you approach it if one wants to make a long-term, strategic allocation into this segment?
So follow the framework explained. So valuation, buy them when you don't want to buy them. Very simple heuristics, rule of thumb. You buy them when the lumpiness or the disorder is playing on the downside, in a Mudistan kind of a scenario where they have disappointed on the earnings side, the stock is down because the sentiments are down. There are more sellers or more negative chatter on Twitter against that name. I think that would be the time to go, full steam ahead and buy, or maybe acquire the major chunk of what you want to buy. The flip side is when everything is hunky dory, the earnings momentum is there, the stock is making new high. That probably is not the point to go all cash and deploy at that point in time, because again, Laura 700 came all the way to 300 or 280 or wherever, right? Buy when no one wants to buy and you yourself are petrified, because that's the best kind of opportunity for you as long as you have done your homework against that business and the management. Buy when the lumpiness is on the other end of the extreme or the downward extreme, and then just ride it out. Time is your friend, and then you will get the other or the extreme scenario playing out eventually.
Okay, Sajal, would we be having time to take on board some more questions?
If you are comfortable, I'm comfortable, Mobeen. I mean,
Okay, all right.
I've got
Okay.
all the time.
Okay, so biotech, what's your take on that? We have a question coming in from BK. He's saying that, of course, he's spoken about a specific stock to Concord Biotech, but I think I'll just also alter that question a little bit to speak about your take on biotech and, in terms of the entire anti-fragility framework, where would you sort of rank this entire business?
No, so biotech as a business, fermentation as a business is definitely anti-fragile, because that's where the puck is shifting. If you look at the gross margins of Concord Biotech, again, I'm not invested, it's not a recommendation. I think they're doing pretty good. The growth is a little challenging given the valuation. But if you compare the gross margins of Concord Biotech with, let's say, Biocon. So Biocon has got three elements. There is a biosimilar business, there is Syngene, and then there is their fermentation core based business. Syngene is 70-75% gross margin. The biosimilar also, I think, is a good margin business. But then the console margins are below Concord Biotech, which kind of tells me that their core fermentation business is struggling. And Concord has got an upper hand as far as the like for like comparison of the fermentation API business of Biocon, because Biocon started from that base. So they were into industrial enzymes and they transitioned into biosimilars much later. But I think they have gone on an overdrive with biosimilars, and maybe in that quest and the oral insulin plus the biosimilar, the base business of fermentation based APIs have kind of suffered. So in that perspective, I think Concord Biotech is good. Again, the stock has run up. Again, I would follow the same approach. If I want to buy something like Concord Biotech, I would wait for something negative to happen. I'm looking for a negative black swan, that there's some accident happens, they disappoint or they overpromise and underdeliver. People start disbelieving in the management. Stock started the downward correction. At that point in time, maybe it would be a good idea to accumulate. So you can't. Your
Okay, so
voice
there we
is.
go. Yeah, Vivek, your question on Concord Biotech has been answered. That's Sajal's view. AI, Vidya Sagar has posed a very specific question on that. Obviously, there's been a lot of advancements. They've sort of shortened the period as well for drug discovery. The most recent advancement seen is through AlphaFold, in protein discovery. So to what extent could this disrupt the biotechnology space? And also, does it, increase the probability of disruption or the near extinction of certain businesses in the space too?
Yeah, I think is the Darwin's principle that will play out, the survival of the fittest. But I think I look at AI as an opportunity rather than a threat. It's kind of increasing the productivity of that scientist, and it's also increasing the universe of screening. So now you are able to screen a wider canvas of molecules, and you are able to do that faster. So you likely get more extremist sons, hopefully, and it's an enabler. So it's like internet, right? When internet came, many businesses got disrupted and they were obliterated. They are nowhere here. But then many businesses have thrived, not just Amazon and many more using that internet. So I would use the same analogy, and that what the Nvidias of the world are creating. They are just creating infrastructure, and many success stories will start leveraging that sort of platform to do more and do better. So Narayana, we gave that as an example. Artificial intelligence is already helping them in diagnostics. So it's kind of faster throughput, straight through processing. In most cases, you don't need a human intervention to screen the result. I mean, you get a faster throughput, and likewise for a scientist, it's much more efficient to screen the preclinical basket of assets and only bring the healthy candidates into phase one, where the probability of success. So phase one to commercial, historic probability is 8%. If artificial intelligence can help that 8% become 10%, that will be a huge outcome, huge positive outcome. And that's what I expect this new technology to do. Of course, businesses will die, and they have to die. See, if for the whole to become anti-fragile, the constituents have to be fragile. They have to die. and vice versa. If the whole is fragile, then the constituents becomes anti-fragile. It's never the case where your constituents are anti-fragile and the whole also is anti-fragile. No, it never works that way.
Okay, so I think we're all done with most of the questions. I'm hoping all of our participants as well have got a good chunk of their answers. The idea was, of course, to be able to absorb as much as you can from the lovely presentation as well you made, Sajal. Very exhaustive. I hope it gave all of our viewers a good guiding source for when they have to analyze businesses from a point of view of what's the moat they have or how anti-fragile they are. However, I am going to ask you one last question, and it's
Sure.
actually asked by one of our viewers too. So Sajal, what is the one thing that you changed in yourself in general life to adopt anti-fragility, and how did it benefit you?
Yeah, so HDFC example, selling when the stock has doubled, taught me that time is my friend. My upside is much more if time is my friend. And I've also stopped using DCF. So discounted cash flow, I don't do that anymore. I used to when I was fragile. I used to predict a lot of things which I have completely stopped doing. So I don't predict. I buy low and my upside is wide open and I don't need to predict and the future. And I think that's what I've changed, and I've also transformed my thinking into longer term. So my downside is much less if time is my friend. All I need to do is partner with a great management, and that management will sort it out over a period of time. And of course, they will make mistakes. Every management will make mistake, right? And we are humans after all. But a great management will create opportunities over a period of time. So they may make 10 mistakes, but they will make thousands of great decisions as well. And on an overall basis, with adjusted for time, which is 15, 20 year kind of, or at least 10 year, I will be handsomely rewarded.
All right. Okay. I think lots of valuable lessons, Sajal, and so many, I think, anecdotes that you have shared are something that we can all take away from and apply in real life too, especially that whole point that you mentioned with respect to HDFC Bank, that only if you had just held on to it, whatever you had
Absolutely.
lost in the previous, in the other private
Also,
bank.
I applied in 100 IPOs. I only made money in 2 or 3. So Balaji Amines was one, HDFC Bank was one, Global Trust Bank was. So 3 or 4. Global
Yeah.
Trust went to zero, that's fine. But
Yeah.
do nothing for 20 years and you see the difference. Even Lupin, as an example, it's nowhere close to its previous high of 2015. But I vividly remember Lupin was a 300 crore market cap company in 2001. Look
Wow.
where it is today, despite all those US FDA challenges. And so many Madistans will happen. Time is your friend. Just hang in there.
Hmm. All right. And I think when you say such things, it's also very encouraging to all of our investors that if you can make mistakes, so can we. But like you
Everyone
said,
makes mistakes. And Warren
yeah,
and Charlie made mistakes in Dexter Shoes,
yeah,
IBM, Tesco
yeah.
UK. Mistakes are fine as long as you learn from those mistakes. That's the fundamental lesson. Learn from your mistakes and don't repeat them.
Okay, well, all of these pearls of wisdom, Sajal has, of course, shared in his book, which, let me reiterate again, he's been so kind, to not take home a single penny from the proceeds of that book. Everything will go to charity of his choice. And of course, through this webinar, Sajal would also like to remind all of the participants that please go ahead and contribute to your charity of choice. With that, we'll wrap it up. Thank you, Sajal. Thank you to SOIC Finance as well. Thank you for giving me the pleasure and the honor of hosting you. Good night, everyone.
Thank you, Mubina. You have been a great host, and thank you, SOIC again. Thank you. Bye, everyone.
Thank you, everyone. Thank you so much. Thank you.